I'm Ted Seides, and this is Capital Allocators. This show is an open exploration of the people and process behind capital allocation. Through conversations with leaders in the money game, we learn how these holders of the keys to the kingdom allocate their time and their capital. You can join our mailing list and access premium content at capitalallocators.com.
All opinions expressed by Ted and podcast guests are solely their own opinions and do not reflect the opinion of Capital Allocators or their firms. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. Clients of Capital Allocators or podcast guests may maintain positions in securities discussed on this podcast.
My guest on today's show is Stephen Nesbitt. Steve is the CEO and CIO of Cliffwater, an investment consultant and asset management firm specializing in alternatives that oversees a combined $110 billion, including nearly $30 billion in private market interval funds that began just 5 years ago. Steve founded Cliffwater in 2004 to serve the burgeoning institutional market for alternative investments and bet the farm with a pivot to managing private credit assets for RIAs in 2019. That shift has been one of the most successful initiatives in the industry in the last 5 years and catapulted Cliffwater to one of the market leaders and brands serving the RIA community. Our conversation covers Steve's journey as a consultant, formation of Cliffwater, and focus on alternatives. We then discuss his strategic shift to managing assets for RIAs, including the development of a private debt index fund, innovation in fund structures, management of liquidity, distribution in the RIA channel, and new initiatives on the come. Before we get going, I'm excited to tell you about the 13th Annual Boston Investment Conference to benefit Boston Children's Hospital in collaboration with the Broad Institute. This year's event takes place on October 24th in Boston and features a ridiculous lineup of speakers, including Boston investment legends Seth Klarman from Baupost, David Fialco from General Catalyst, Nancy Zimmerman from Bracebridge, Will Danoff from Fidelity, Alex Sacerdote from Whale Rock, and Gavin Baker from Atreides. And they may all be upstaged by Brad Stevens, president of basketball operations and former coach of the Boston Celtics, and Roland Fryer Jr. from Equal Opportunity Ventures. My good friends Josh Gold and Matthew Sidman created the Boston Investment Conference to bring together great investment minds for a great cause. It's a fantastic day to do well and do good. Visit bostoninvestmentconference.com to learn more. Please enjoy my conversation with Steve Nesbitt. Steve, thanks so much for joining me.
Thanks, Ted. Good to be with you.
Why don't you take me back to what got you started in the investment consulting world?
I was very lucky. I've had 3 jobs in my career. The first coming out of business school was with Wells Fargo Investment Advisors, and they were one of the first to do index funds, if not the first. And I got to work with some very smart people, in particular, Bill Sharp and Bill Faust. He taught the dividend discount model to me. I thought that was fascinating because he had a way to project expected returns on equities rather than just looking retrospectively at historical returns. And that was really important in the evolution of asset allocation. It allowed people to pivot from just looking in the rearview mirror to looking forward. I got involved in asset allocation along with index funds. Wilshire Associates hired me in 1980 because they thought I knew something about asset allocation and they wanted to start a consulting business. So I went there, and at that time, consulting was all about manager selection. And Wilshire stood that on its head and said, no, manager selection is not important. It's asset allocation. I was a consultant there for over 20 years. I ran the consulting group for about 15 years. Success there was on the premise that we spend 90% of our time on manager selection, but really it's asset allocation that's going to determine returns.
So in the implementation of the asset allocation, how did you reconcile your early experience with index funds with this model of manager selection tied to the asset allocation?
It was really a question of where are the markets efficient and where are they not? People hired Wilshire at the time because they liked the idea of efficient markets and provided a pretty simple solution as opposed to hiring 50 managers. And so our philosophy was, hey, we're going to go index where the markets are efficient, and we'll hire managers where they're not efficient. We thought the U.S. equity market was efficient. So we pushed index funds for my tenure there. But in maybe small cap stocks, international, we'd have some mix of passive and active. And it just seems to me the world has basically gravitated slowly to the efficient market thinking, except for private markets, where arguably there are no markets and where the real economy is inefficient and you can take advantage of that.
What did you see in those 20-something years of the evolution of the sophistication of asset management?
I think that's two levels. One level, there's been no change. It's amazing to me that investment theory changed radically in the late 50s, early 60s with Markowitz, Bill Sharp, Gene Fama, basically modern portfolio theory. But we've lived with that theory to this day. Maybe I'd throw in there option pricing, but nothing's changed. I still have a couple textbooks from my MBA days at Wharton. They could be used today. It's amazing. So in one sense, the paradigm hasn't changed. On the other hand, so much has changed in terms of execution and implementation. So the availability of data and data processing is light years ahead. Also, proliferation of asset classes. Okay. Back when I started, it was stocks, bonds, and real estate. Institutions loved real estate. Trustees could count the number of parking spots. It seemed to be the only private market that resonated, but it's crowded now. If you have an asset class, you're competing with arguably 30 or 40 other asset classes, and it comes down to asset allocation, portfolio construction. One of my gripes is sometimes people over-diversify. They're not sure, so they end up with godly number of asset classes, which really doesn't do anything from a performance point of view.
What led to your founding Cliffwater?
Couple things investment-wise. I felt at Wilshire I had accomplished everything I could accomplish. It was getting a little bit routine. I had built in the 90s private equity group, a hedge fund group. Going into the new century, I was convinced that it was going to be alternative investments, that no way 60-40 was going to meet the actuarial rate. My feeling was in alternatives, we could add 3 percentage points net, shift up the efficient frontier. And so I said, hey, we're going to establish a firm that focus 100% on alternatives. And that was the investment backdrop. Economic backdrop is I didn't have much equity, and the other partners that joined me didn't have much equity. So this was a way for us to generate some net worth for ourselves.
And how did the business progress in, say, the first 15 years of Cliffwater's experience?
Used the same playbook I used at Wilshire. And that playbook was establish your credentials with the highest level people. So we became advisors to some of the largest pension plans here in the US and some abroad. And then we knew there were clients that were interested in discretion. And so the idea was, hey, however long it took, establish your reputation and then move into a more discretionary role. Have a blend of the two. Been successful doing that before. And so thought, let's do it again.
How did you think about the research process of what types of managers you would recommend across the different asset categories that you were covering at Cliffwater?
It varies by alternative asset class, but there are some alternatives where manager selection is almost everything. In venture, you can make the right asset allocation decision, but if you can't get the best managers, or at least the top quartile managers, it's not going to matter. It's not going to deliver. That's most true in venture, maybe a little less so in buyout and hedge funds. But unlike the public asset classes where you get 99% of your return from beta, you get the majority of your return from manager selection or alpha in the case of those asset classes. I think the difference was private debt is different. Most asset classes, there's upside optionality, fixed income and private debt as well. It's downside optionality. And so there it's diversification. And there are a lot of good managers. And so we focus a lot more on beta than we do on alpha, which is limited in the private debt class.
Let's go through them one by one. So in venture, there's this notion that you just have to be with the best. How do you figure out who the best are?
Track record counts for a lot. The venture industry started in the 70s, and there was a lot of persistence in performance, a lot of well-established platforms. Things change, obviously. There are lift outs and splits and so on and so forth. But we have identified others sustainability in terms of returns on the part of some venture capital firms. You start with that. You say, looking ahead, Do we have the same partners? Do they have the same opportunity set? So on and so forth. We produce these 30, 40-page due diligence reports with a lot in it, but it comes down to a few things: performance, people, philosophy. That's been a good blueprint for evaluating managers generally.
How have you gone about getting access to the ones if they're so readily identifiable through track records?
Can be tough, particularly in the venture capital space where there's a shortage of supply with who you identify the best managers to be. It comes down to relationships and longevity of relationships. You could also be lucky if you're an institution like University of Michigan, Stanford in the industry that they can get access. We've dealt mostly with public funds on the advisory side. That's a little more difficult. They have special requirements that a lot of venture firms do not like. We've had some success leveraging off our own relationships, helping our clients into them. You can also establish a relationship sometimes to the secondary market. You buy a secondary, all of a sudden you're in the club, and that helps. So there are some tricks, but no, it's basically having the GP recognize you as a good and reliable partner. Sometimes there are significant drawdowns in the market, and having a willingness to step in, that counts for a lot.
How about in private equity in the buyout side?
Basically the same thing. You don't really have the capacity problem. In a few instances over the last 10, 15 years, it's been middle market buyouts that seem to have produced the greatest value add. And again, it's relationship building, being a good partner, them knowing you can count on capital when they're ready to launch a new fund. So just that consistency. We've been doing private equity since the beginning. I remember my eyes opened. I was at an Oregon Investment Council meeting back in 81 or 82. George Roberts was there talking about what he does. And I was just, as someone who was efficient markets, quant, blah, 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 this guy making a lot of money for the state of Oregon, it was completely different. So being a witness to success and failure, lessons learned over a long period of time has really been useful to me in judging private equity, who are the winners and who are the losers.
So we met a long time ago in and around the hedge fund space, and probably more so than venture and private equity. It's changed quite a lot in that period of time, last 2 decades. Would love to get your thoughts on how you've participated and how that's evolved.
The holy grail in our industry is that Northwest quadrant, high return, low risk. When we launched 20 years ago, traditional low risk asset classes, publicly traded fixed income, yields had come way down. No new math was going to get you to the actuarial interest rate. There's been this look for strategies that could get you in the Northwest quadrant. Coming out of the 90s and early part of 2000s, hedge funds looked pretty good. And some of the strategies, mostly arbitrage strategies, looked to be sustainable, so on and so forth. So you could earn an equity-like return at a bond-like level of risk. That looked attractive. Unfortunately, that industry got very crowded, very fast. The reliable arbitrage opportunities just didn't seem to be there, or at least not at the level to get you an equity-like return. I think the watershed year was 2008 financial crisis, where hedge funds were down 20%, and they were supposed to protect capital and didn't meet that standard. And we've gone through the last 15 years since the financial crisis where people have ratcheted down their hedge fund allocations. And I don't know, there are, at least in my opinion, maybe a dozen hedge funds that really matter today.
I'd love to ask about how you thought about the changes and the state of your business leading into what's been this very significant shift over the last 4 or 5 years.
The consulting business, in a sense, from a business perspective, has gotten very concentrated and virtually zero growth, where you probably have 5, maybe 10, but not much more than that, really sharing the pie amongst themselves. Sometimes it seems to be a zero-sum game there, and it competes on fees. All these top firms, very qualified, very good, have very good people, but the problem is they're not very differentiated, and it's questionable whether they're really adding a lot of value other than education and check the box on fiduciary oversight. It's a very tough business. Margins are very low, single digit, zero growth. It's hard to attract really good people in that type of business environment. I think all of them, like us, have been interested in finding a clientele that values execution, can execute themselves so they can differentiate themselves, so they can charge higher fees, attract better people, and add value. For us, I think we had the right idea in consulting. We were just undersized. And we focused on alternatives. But then after the financial crisis, the general consultants decided to do alternatives as well at a much lower price. So we were getting squeezed.
So you have your business, you're undersized and you see this consolidation. There's no growth, low margins. You got a bunch of people, you got a bunch of clients. That's a tough position to be in. What did you do?
It's very tough. We had some options. We could merge with another bigger firm. We looked at that, a firm that might have global offices, whether that mattered or not. Their head count was in the hundreds and not the tens. That would have been a logical option for us. And there were a number that didn't have alternative capabilities. So that was interesting. And we did look at that, honestly, to solve our growth problem. But it just so happened that the emergence of private debt caught my eye early on. And going back to this idea of the Northwest quadrant, the yield curve had basically gone to zero. And it was like, is this an asset class that has growth itself? Can we manage it? How do we manage it? Could it be big? Could it be the new thing? And I thought it was the new thing. And basically, arguably, we bet the company on that asset class.
So what was your base case for why you wanted to make that bet?
The private debt we were interested in wasn't distressed. You didn't need to be a rocket scientist. All you needed was access to senior secured loans backed by viable companies. The yields were extremely attractive. And the question became, hey, can you hire managers that can underwrite those loans to close to a 0% default rate? I felt that was the answer. We'd still do hedge funds, but I saw this as a more simple and more elegant answer to that Northwest quadrant. And it just so happened there were a few, not many, that had done this through the 90s into the 2000s that I knew they performed very well during the financial crisis, hedge funds for the most part. And I felt, hey, let's do our due diligence on this asset class, on these managers, and start recommending them. So that's what we did. When we got interested in private debt, I was amazed. There was really no data. There was no index. So I felt that it's like any asset class. It's not going to take off until it has an index. I often say it's like in the Wizard of Oz, the scarecrow. He wants to be recognized as smart. He is smart, but Wizard says, all you need is a diploma. And then everybody will think you're smart. I've discovered in the consulting business, in the institutional business, you need an index before you fit into asset allocation. So we spent an incredible amount of time, like 5 years, building a database and creating an index, Cliffwater Direct Lending Index, engineering that back to 2004. So people could have a good idea of what this could do. I thought they're not going to hire a specialty private debt consultant, too many consultants. So I said, hey, this is new. Why don't we do a kind of a fund of funds? I thought that was a simple solution, charge low fees. Fund of funds weren't particularly popular, but I thought we could. The value add proposition was huge. We ran into the problem that we couldn't sell this to our existing client base because you have a fiduciary problem. No, can't recommend ourselves. So started to talk to other funds. And the problem was we couldn't get through their consultants. The other consultant didn't want to recommend us, quickly discovered raising capital was going to be a problem. Here I have, I thought, really great idea, but I can't sell it into the market.
So I'd love to dive through different aspects of that process. The index creation, what are some of the complexities that you walked into as you started thinking about creating what became the direct lending index?
I've been familiar with indexes my whole career. I learned about them, actually implementing them at Wells Fargo Investment Advisors. So created a couple indices, 2 or 3 at Wilshire Associates. When it came to private debt, once I had the data, I knew how to create the index. And fortunately, the BDC market, not many people knew about it. These are 40 Act vehicles, so they're SEC registered. And the SEC requires disclosure on a quarterly basis, including holdings. If you can manipulate SEC data, you can create an index. People can replicate our index if they're now willing to spend an incredible amount of time and resources doing it. We scrubbed, sliced and diced SEC data to create this index. It's an asset-weighted index of the underlying collateral. I analogize it to NCREIF, the real estate index, where it's a index not of properties, but actual loans. And it's actually better than NCREIF because it's not populated by managers voluntarily giving their property values, but this is all SEC mandated information.
Once you got conviction in the area, you look today and you've had this incredible growth. on the asset management side of your business through this debt asset class in a completely different market. You often find people with a good idea that you had that are long the concept and short distribution. Really curious how you made that pivot from serving mostly public pension funds in consulting to creating a product and then figuring out how to bring that into a completely different channel.
Kind of like if you build it, they will come. When investment business, they don't come. I was just lucky enough, a young professional, maybe he was 30 years old, who had been following my research, who came to me and said, hey, you ought to meet with a bunch of people I sell to. He was selling BDCs to individual investors and to RIAs. And said, you ought to spend some time with this RIA channel because I think you could be very successful in it. And so I spent a year meeting with the RIAs he recommended. And I said, hey, let's switch the RIA channel. And that was it. We figured out, hey, what's the best fund structure to make it easy for these RIAs? So we selected this interval fund structure. Others use BDC and offering yields closer to 10 than to 0. That got us started. We took advantage of a market that was severely underserved, this RIA channel, that was gaining in size and sophistication. Sales into that channel were product pitches and substandard products with high fees. Phil Hasbrook was working in that channel. I think he was somewhat successful in that channel, but I had the idea of cold calling me. And part of this is just listening to people and even young people and being willing to take business risks. That's how it all got started. And I quickly determined that these RIAs, generally they manage between 1 and maybe 20 billion. They're very smart business people. They have some investment skill, but they don't have the resources, particularly the resources to do alternative investments. They really needed advice as well as good product. I think we've been successful because we have great product, but we also can give them institutional advice that single product salesmen can't give them. So, for example, maybe you have an RIA, gets a new client, they've got some venture fund that's being onboarded. They have no idea if this fund is any good or not. And while they may be invested in our private debt product, they may call us and say, hey, Steve, is this fund any good? And we can give a quick answer. That value add or that advice beyond just a single product, I think is really, for us, the difference between success and not.
How do you go about getting your initial traction with the first interval fund?
I leveraged off the Rolodex of this person. I had hired him like a year before to do all the prep work and everything, but he onboarded somebody else. So I had an East Coast person, a West Coast person, and we raised, I think it was like 120 million out of the box. That got us going. I will say launching a 40 Act fund, a tremendous vehicle, but getting one launched is extremely difficult. You got to go through the entire regulatory process, which is a bear. You need to raise capital to launch all at once. And with an interval fund, there's not drawdown capital, that kind of stuff. But there are huge advantages, but getting it launched is a challenge. And you just have to be committed. And we were committed.
What are some of the advantages of the interval fund product?
It's like a regular mutual fund. So for RIAs, individual investors who are familiar with mutual funds, it's SEC oversight. So people feel safe allocating to a SEC registered fund. It's not a private fund. The interval fund specifically, you can invest on any day. It's easy. I just execute a ticker on Schwab, Fidelity, TD, whatever. I'm invested tomorrow. You don't have all these subscription agreements, all this accounting stuff that goes on. It's 1099. It's incredibly convenient. The only thing that's restrictive is getting out. So you can only get out once a quarter, generally a fund level gate of 5%. But for us, except for one quarter during COVID, anybody who wanted to get out on any quarter could get out.
What are some of the drawbacks of the structure?
The drawbacks are asset liability management. So you have to manage the liquidity. That's not an easy task. So every quarter we will redeem or repurchase up to 5% of shares outstanding. Our flagship fund is over $20 billion. So $1 billion will offer repurchase. We have to have liquidity to meet that potential of $1 billion. And so we don't want to hold cash because cash is a drag. People are paying us to hold private assets, not cash or liquid credit. Having credit facilities in place where we can draw $1 billion on a few days' notice. That's not an easy task. And if you have an asset team, you got to have a liability team that's first class.
So as you started this with $130 million and the flagship's now $20 billion in just a couple of years, how did that all happen?
I don't know, Ted. Sometimes you're lucky, but it just seemed to be a right product at the right time in the right market. Sometimes you get everything right. I've had a lot of strikeouts in my career. This was one where I think it all worked. I will say the RIA market was a huge decision for us and a big payout. 7 years ago, when I started talking to lenders and managers saying, hey, I want to do this fund and I want to go to RIA channel, I think they said, oh, that's great, Steve. Good luck. We're in. But I don't think they thought we'd be successful at all. And it just happens that that is the market that everybody wants to get into these days. I will say we work with close to 800 RIAs. And before we launched this product, before we went to RIA channel, maybe I get 10 to 15 outsiders on my quarterly asset allocation call, our institutional clients. And now I get 500. They want objective advice. We found a group that was starving for independent and high quality information across asset classes.
You have 800 different and a growing number of RIAs investing. You started with one and then two East Coast, West Coast people that you brought in. What does that team look like today to cover all of those clients?
We have 30, maybe 35. We're North America centric. We have a very young group of incentivized, hungry salespeople. I will say early on, we're not on the investment banks. Our shortcut is to go find another distributor, go to an investment bank or another wire channel. We're going to compete with the Blackstones, et cetera, and those channels. No one knew who Cliffwater was. So we decided to build a sales staff. And that was a very important decision. If we're going to fail, I didn't want no excuses. I didn't want to blame an investment bank.
How have you gone, let's say, the investment process within the product?
So first is our philosophy, diversify. You only have downside optionality. So diversification is a free lunch. The problem with single manager funds is in portfolio construction, therefore diversification, they're captive to their deal flow. Your portfolio construction is incredibly constrained. Individuals can get around that by hiring a whole lot of managers. And if you look at the institutional markets, people are hiring 10, 20. With our interval fund, our philosophy is maximum diversification. We've got over 3,000 credits in our fund. And importantly, at the largest credits, everybody talks about, hey, my average position as a percent of the total portfolio. First of all, you shouldn't look at total portfolio. You should look at net assets just for leverage. But you'd be surprised if you look at the largest credit of a typical fund, the largest 5, largest 10, how concentrated they are. And it seems every quarter, some manager goes into the penalty box because one of the largest credits has a problem. But for us, our largest credit is well below 1%. So in NAVs, I call this a quasi-index fund. So basically our fund, we access loans from many managers. It's diversification. We're capturing beta. I know things will go wrong, but I know it won't wake me up at night.
When you're trying to capture beta in an asset class that's, let's just say it's priced as an alpha asset class in terms of how the managers price their fees, how do you think about trying to drive down the cost of achieving the return in the asset class?
Like in most of the private asset classes, you drive it down through co-investments, secondaries, depending upon the price discount you can get. We do other things. We warehouse for season and sell for other lenders. So basically we get a lot of zero fee or low fee type loan collateral. But on the flip side, we try to help our lenders, those who provide us loans, with things they really want. It may be an SMA where we negotiate fees based on scale. So they have some sense of permanent capital they can rely on. And we also do some primaries. But primaries we do is we'll be first up. If a manager wants to launch a new product, getting that first dollar in seems to be very valuable to managers. We'll step up in scale and give them an allocation. So, hey, what's important to you? What's important to us? And we strike a relationship that works both ways.
How many different manager relationships do you have in the flagship interval fund?
I'd say there are probably 15, which are big. multi-billion dollars, and maybe another 5 or 10 that are smaller size.
Now that you have a brand and significant traction in the channel, what else do you think about doing to help serve the RIAs?
We started with private debt, the easiest asset class really to implement. And then we did a higher octane credit product that's going well. We just launched private equity. So we started the company thinking alternatives could add 3+% net risk adjusted, so across an efficient frontier. So we started with the lowest risk alternative, and now we have the highest risk alternative in private equity. There are some between asset classes, that's infrastructure or real estate. Those will be coming. I don't think our investors are missing out on anything, not doing those right now, but particularly infrastructure as an asset class, it needs to develop further before it's really useful to us. And of course, real estate's out there, but can't seem to sell anything with real estate today. So we're focused on private equity right now.
I'm curious how you put together a product for private equity that has liquidity when the underlying assets don't, right? At least in the credit world, there's a yield, and you can imagine distributing out that yield for a return. How have you built this in private equity?
It's liability management. Can you do private equity? If you use the typical institutional playbook, you can't. Okay. If you're doing primaries, you got these big unfunded commitments, that implementation approach will not work. You're going to get yourself in trouble. But first of all, you've changed strategy on the private equity. Do very seasoned primaries or secondaries or co-investments where you don't have these outstanding unfunded commitments. That's where you start. Fortunately, we were in the market where the secondary market and co-investments is very active. So it's a good time to launch private equity from that regard. On the liability management, same thing. You should have a fund level credit facility, preferably a revolver, that gets you access to liquidity should you have any quarter mismatch between inflows and outflows. The third thing is we don't provide the same liquidity terms on private equity that we do on private debt. It's semi-annual. It's half of what we do on private debt. You need to be very sensitive to your actual and contingent liability, because otherwise it's game over if you can't meet those redemption requests.
So when you launched private equity just in the last year, it's already crossed $1 billion. How did you put that money to work at a cadence that's consistent with this incredible interest you're getting in inflows?
If you have a good team and reasonably good access, you can basically manage your launch date to your opportunity set. So what the optimal launch time is. We're not holding a lot of cash, or if we're holding cash, it's going to be for a very short period of time, and we can have a good experience. I will say on the private equity, we didn't launch from zero, just cash. We negotiated with a large insurance company that had a private fund, and we bought that private fund, flipped it to an interval fund, and on we went. There are a lot of these tricks you can do, but you got to know how to do it. It's complicated. And be prepared to have a lot of lawyers on staff.
So having been inside this for the last couple of years, the same investing activities in a different channel, I'm curious what you see on both sides. So first, maybe what advice would you give other managers that are thinking of trying to attack the RIA channel?
If it's private debt, it's crowded right now. So RIA channel, you have a few interval funds that matter, only a few. So it's going to be a long slog if you do an interval fund. The private BDC market is now very competitive. So it all comes down to fundraising. If you're sitting there and you're a large asset manager, you think you have good distribution, fine, go ahead. But if you don't have RIA distribution already in place, where it's a cross-sell, it's going to be challenging. Or if you're a good manager, good lender, private equity manager, you don't want to do it yourself, go RIA channel, give us a call and negotiate something. We've become a conduit for many managers into the RIA channel for SMAs and other stuff.
Then on the other side, I'm curious what the receptiveness with your traditional clients on the consulting side and the institutional community has been with this growth of the interval product.
It's two things. So our legacy clients, they know us. Generally, they've been with us many years, in some cases, decades. So I think they look at us, I think they recognize, hey, this is a different firm. Cliffwater, my level of services that I'm getting from my consultant Is that changing in any way? Is it improving or is it getting worse? I think during this period for us, there's a high level of focus. I like to think that our stability, we're providing them a level of expertise we couldn't before. I believe they've viewed that positively, but I'm not exactly in their shoes. So in terms of new client acquisition, we've been picking up some clients abroad, but I think the knock on us is, oh, they're an asset manager now. They'll put 100% of our portfolio in private debt. We find our relationships with the institutional market very valuable to us. Generally, that's where the highest level thinking is going on. It's a tremendous source of intelligence for us. We don't want to let go of that. But on the other hand, we've got to be realistic here.
How have you seen the comparison of what you're able to deliver in the interval fund product compared to, say, what you may have recommended in the past to the institutional market in the same asset class?
I recently looked at that. We've been doing these funds, for example, the debt funds, for 5 years now. We looked at our clients, what their performance has been, and it's close to 10. In terms of bottom line performance, our institutional clients have been doing comparable to our own RIA performance. That's good news for the RIAs because they can say, getting in the institutional level of return. I think from the institutional side, they should be able to say, we're getting Cliffwater's discretionary performance. So it's not like they're misallocating deals one way to our discretionary products. More importantly, with the study, I found that I looked at roughly 35 big public funds that have disclosed June 30 numbers. Their average number is a high 7. There are a couple of funds that have kept pace with us. We respect them all, but I think a lot of times they suffer from over-diversification. A lot of people seem to think in the name of diversification, all of a sudden they'll do some price niche product. I do think our product, we can deliver institutional plus returns to the RIA channel.
Have you seen any movement of institutional capital into the interval fund product that's comparable returns, better liquidity, better transparency?
No, it's a little bit frustrating. But on the other hand, when we partner with lenders, they're all focused on the institutional market. We don't want to compete with our suppliers, if you will. But I just think the other consultants to these funds, interval funds, even BDCs, they're starting to come around to BDCs. But they say, oh, that's a retail product. It's not for us, kind of thing. So be it. They can have their 7s and we'll take our 10.
I want to make sure I ask you, as you look out in the private credit markets going forward, what do you see as the risks in the space?
This is really easy business. This is yield, which I call beta, minus losses, credit losses, defaults, minus fees. Even my granddaughter, I think, understands that. You can control fees to some extent, or at least manage them. So it all comes down to losses. The average loss rate in this market, like the leveraged loan market, is 1%. We say yield is beta. That's efficient in the marketplace. It's for the same loan, no one's getting a better yield than anybody else. It doesn't exist. But there are some better underwriters and less better underwriters. So the question is, how much alpha is there? The average loss rate, if you bought everything, is on average 1% per year. It's kind of lumpy. During recessions, it goes up. Last few years, it's been below average. So that's your potential alpha. The risk, if you study credit losses, it's all correlated to recession. The downside case in private credit is a prolonged recession. If you look historically, 2000, 2002, that was a fairly deep and prolonged recession. The good thing about having data now with the index, we can measure credit losses during those time periods. And then when you do manager due diligence, you ask, hey, how did you do during these periods? You know what the maximum alpha is.
How do you assess the risk of deteriorating underwriting standards as more and more capital comes into the private credit space, into these managers?
Standards haven't changed. The market conditions have changed. So maybe you can't meet your standards, so your deal flow becomes restricted. That ebbs and flows. One of my partners says everything's cyclical. So hedge funds will come back one day. Right now, spreads have come in. There's probably an excess of demand relative to supply of opportunities. So instead of 12% that we've been looking at, probably earn with Fed funds coming down, we'll probably be looking at 10%, maybe 9%. Inevitably, the market changes. If all of a sudden we go into a recession, the flip will happen. The spreads will widen again. We're like at 2001 again, and where things looked a little tight. And then 2002, most of 2003. It was a very good time to put money to work. Now it's maybe a little bit less so. From our investors' point of view, hey, private markets are going to offer you 3 to 4% higher return. That's going to ebb and flow. But there's always going to be delta there. I can go back to the 80s and tell you that everybody thought the private equity premium would go away. And it's really been pretty consistent at 3 to 5%. I expect the same on the private debt side.
As you step back after having really made an incredible transformation in the business of Cliffwater, I'm curious what lessons you take away from that experience, particularly over the last 5 years.
You just have to keep an open mind about everything and survey the broad market. If you're successful, it's hard to change. And that may be true for us too now. But if you're struggling, you got to be open to change. And fortunately, I had partners who maybe beat me up a little bit, but were willing to make a big change. It was a huge change for us. I just think be willing to take some business risk along the way.
All right, Steve, I want to make sure I get a chance to ask you a couple fun closing questions. What is your favorite hobby or activity outside of work and family?
Golf. And it's not because I'm a very good golfer or particularly like golf. It's such a frustrating game, but I like walking courses. It's the greatest fun. And if you can afford a caddy, you don't have to lug around a bunch of clubs.
What's one fact that most people don't know about you?
I was interested in how much time of my life have I spent on a plane. So I've been in this business 45 years, traveling this client, that clients, some places to not so great places. I travel about 6 or 7 million miles. If I did that all at once, how long would that be? It's like almost a decade. I spent a decade of my life, did LA, New York equivalent. So it would be like, okay, for the next decade, every day I'm going to get up, go to the airport, fly from LA to New York, sleep there, get on a plane, next day, go New York to LA, 10 years. So I think if I knew that when I started, I wouldn't have gotten into part of the business I got in.
So with all that travel, do you have any favorite travel tips?
A partner gave it to me. So if you travel around a lot, particularly in the wintertime, you get stuck. We were based in LA. She said, Steve, look at the board, find a flight to Las Vegas. Those flights always go. They're generally Southwest. And she told me this 10 years ago. And she's absolutely right. Every place goes to Las Vegas. And those Las Vegas flights, they always go because generally these are package deals and there's a lot of economics writing on those deals. So I pass her advice along.
What's your biggest pet peeve?
This sounds stupid, but I can't handle the TV remote. I've been moving quite a bit here over the last few years. I can't believe how complicated viewing a TV screen is today. It drives me bananas. Why can't someone solve this? I can't understand it. Maybe Elon Musk, if he'd spend a few minutes, he'd probably figure it out.
Which two people have had the biggest impact on your professional life?
First of all, Bill Sharp, because I got to meet him when I took this job in San Francisco with Wells Fargo. He was an advisor there. And then after I went to Wilshire, I was a consultant at CalPERS for most of the 80s, early 90s. He was a consultant at CalPERS. Not only was he incredibly smart, is, but incredibly practical. Not only did he come up with beta and all that stuff, he did measuring the style of managers. He spent a lot of time on how people could quantitatively evaluate managers, which was obviously important in our business. He was also incredibly nice to people, just an incredible person. And I think the second person is not a person, but basically that investment staff at Wells Fargo, Bill Janke, Patty Dunn, who basically built the index fund business for BGI, which now is BlackRock, Tom Loeb, all Polly Schauss, all great people. I was very lucky.
What's the best advice you've ever received?
The best advice is just to be nice to people, be courteous, be nice. That's another reason I like golf, because people are nice, they're courteous. It's not a zero-sum game. Maybe it is on the PGA, but I just find it's a sport that just produces and attracts really good people.
All right, Steve, last one. What life lesson have you learned that you wish you knew a lot earlier in life?
Having good manners is related to your previous question. Just having good manners. Don't be intimidated by people. Whoever you are who you are. People will like you if you like them. And I just think it's not you versus them. Just being nice and good to people and courteous. I wish I knew that because I was a jerk when I was young. And maybe I am in some ways, but try not to be.
Well, Steve, thanks so much for sharing this incredible transformation story, and a warm congrats on your success.
Thanks, Ted. It's always good to speak with you.
Thanks for listening to the show. To learn more, hop on our website at capitalallocators.com, where you can join our mailing list, access past shows, learn about our gatherings, and sign up for premium content, including podcast transcripts, my investment portfolio, and a lot more. Have a good one, and see you next time.